So I know this will be amazing to your viewers, but actually, if you look at the technology that sits at the heart of most banks, it is extraordinarily old. Maybe not quite as old as me, but some of it goes back 30, 40, 50 years. And these sort of workhorse systems have just been, grinding away in the back, recording details of the customers, processing payments, balances, interests. And that's fine in a world where everything was running in batch, and you could let everything wait till the end of the day. But now, because we expect things to be instant, we expect the user experience to be beautiful, we want data to help and inform decision making, those systems just don't work. And what our survey says is, 55% of banks say that this technology is getting in the way of them achieving their goals, and over 90% say they've got to change it if they want to be successful in the future. And perhaps the most scary stat in all of what we researched, and this was 200 banks around the world, is less than 30% of them are using AI in any way. Everybody talks a good game about AI, but if you can't get at the raw data, you can't do anything with it.
Staggering. There's a terminology for this called technical debt.
Yes,
so
yes, exactly.
Of debt that you've accumulated on the technical side that you can't really get rid of. But I was looking at the reason why, and this was from a McKinsey report saying the reason why you would embark upon digital transformation: higher balances for current account savings, lower cost-income ratios, increased customer acquisition and retention rates, faster time to market. This all looks like low-hanging fruit for banking.
Well, I mean, the prize is enormous, right? Look at most banks, their cost income ratios are in the sort of 50s if they're good, 60s, 70s sometimes. On our platform at 10X, we call it Metacore, you can run your bank for a 30% cost income ratio. That's a massive benefit because you can share that value with shareholders and customers. There's a huge prize there. What's getting in the way? What's getting in the way is, you're really trying to get into these, the heart of the bank. And oftentimes, some of these systems are so old, they're not even documented. So people approach it with trepidation. And the good news today is we've created technology that allow people to go on that journey in a very incremental, controlled way that can deliver value in weeks, not in years.
I wonder whether one of the problems is that there are so many different touch points now in fintech that perhaps bankers are somewhat confused as to where to start. I mean, you think about just having great online banking where you can also grow some sort of wealth management portfolio for retail investors. Then you've got the credit card business, which is now going more virtual. You've got payments for SMEs and for big businesses. I mean, the list just goes on and on. Tokenization. Is it a lack of ability to forecast what are the priorities and what you should double down on for bankers? Is that one of the issues?
It's partly that, but it's partly about how you see the world, right? So I think a good analogy here is cars. If you think about cars over the years, they've got more and more and more sophisticated. We've loaded in more and more things, sat-nav, air conditioning, thousands of sensors. And cars have got more efficient. But actually, if you look at an electric vehicle, it's got about 10 to 20% of the parts of a regular car. And although batteries are more expensive now, they'll get cheaper and cheaper and cheaper. So the question is, are you using the most modern, simple technologies to solve these problems so that you can deliver those great user experiences at great economics? And that's where the industry needs to shift its focus from kind of tinkering around the edges and delivering a mobile app or some other capability to really getting inside the plumbing and changing that for the future. Because I believe that's where competition is going to come in the industry. I mean, I just saw your pieces on the banking mergers and so on. Yes, you can merge a bank, but at the end of the day, what do you have? You just have a bigger bank. Until you get inside and really fix these issues, you're not going to be able to drive value.
I've got to be honest, I've been in the same bank for over 40 years. I'm not going to say which one, and I think they're brilliant, what they do anyway. But as you say, that's just what I see rather than what's going on. And actually, one of the banks that was very, very criticised, and you'll know this, in the last decade, for having about 13, 14 different systems, was Deutsche Bank. And that's why there was so much low-hanging fruit for Herr Dr. Christian Saving as well. That said, and if I may move the conversation on as well as self-help as well, we have a stunningly inefficient, split-up banking system in Europe as well. Way too many banks. The stat that there's 1,300 German banks just blows my mind every time, which is 3 times as many as the French as well. German banking is ripe for consolidation, as is broader European banking. Why do you think, Antony, just because you've been there, you've been at the top, one of the biggest banks, why on earth are the Germans so resistant to having a better bank run by a better CEO? Well, is it just because it's Italian?
I mean, look, there's a lot of issues around, let's face it, there are nationalism issues here at play, but without talking about any specific situation, if you think about the history of bank mergers, it's not littered with overwhelming successes, right?
No, I mean, Barclays in Spain, it was really tough.
Most of them have been a complete car crash. I was at Citigroup when Citi merged with Travelers. That was not a good move. And the reason why it was not a good move was because just getting bigger for getting bigger's sake doesn't solve any problems. It's how you're going to create value. One of the problems we had at Citi, and it informed my thinking around 10X, was we never integrated any of the systems. So basically, what economies of scale did you get? At the end of the day, you just had a bigger balance sheet. You could have the same number of people in the corporate head office, but you weren't streamlining anything. And that's where I think the commercial rationale for this really has to come to the fore. And that has to be balanced against the massive execution risk of smashing together two large organizations that might have different cultures, different types of technologies, different business models. So where's value going to come? Because if you can make the value argument, then you can start to get shareholders on board, you can get regulators on board, you can get government on board.
What sort of cost are we talking about these days? Because there's clearly been a number of big attempts to consolidate the market. I mean, Switzerland's one example. We're already seeing the ramifications there. Whether we're talking about Italian, German cross-border action, there's motivation for other CEOs. But what should the starting point be as we think about the technical consolidation and the sort of cost that investors should think about?
Well, we think of banks as being in a different class of other corporate entities or companies, but they're not. I mean, it's the same logic. Okay, where are you going to create synergies in a merger? People talk about revenue synergies. Yeah, okay, we've all heard that, right? Every graph that goes up and to the right. Yeah, I'm going to be able to cross-sell. Well, nobody's ever really made the financial supermarket work as far as I can see. So it really does come into... Exactly. Can you optimize your operational costs? And that is a lot to do with the sorts of technologies that we've been talking about. Can you optimize your capital allocation and balance sheet? That's really what it comes down to. And I think being persuasive on that is important because, as I say, everybody's going to look at those plans with skepticism because the execution risk in these transactions is massive.
Can I ask you about AI? Because you mentioned it briefly before, and what I've heard is that the industry will go slow because there is so much regulation sitting on top of the banks. They don't want to get it wrong when it comes to AI. But where exactly are they at in executing AI, and how far behind are they versus other sectors?
Well, the thing about banks is everything a bank does is data, right? And there's a massive amount of data in banks. So they've got the raw material. And in many ways, banks have always used sophisticated modeling to make decisions. And this goes back 30, 40 years. AI is potentially that turbocharged times 10. But in order to do that, you have to first be able to access the data. And that's a big problem because it's incredibly fragmented across multiple systems in the banks. Then you've got to be able to build algorithms that don't have bias in them, that you understand how work, that you can explain how decisions are made. And that's really the second part of the equation. And that's where, on both actually, the banks are really, really in the early days of this. Now, I happen to believe just because ChatGPT came into the public consciousness, I think AI has been overhyped in the short term. We know this is true of all technology, right? People tend to overestimate in the short term and then underestimate it in the long term. But if you think about what banks do with data, it's incredibly potentially powerful. Streamlining operational costs, automating customer service, making better lending decisions, dealing with fraud more effectively. So there's a huge prize for the industry, but step one is get the data in one place so you can do something with it. Step two is apply modern tools so that you can begin to get that benefit.
Antony, we have to leave it there.